Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the amazing benefits of using options. So options are just really amazing as far as different things you can do. So here's a trade that we set up yesterday on JNJ. This is an earnings trade, and this is what we call a double calendar. So just want to point this out. This is my alert service. So this was sent out to all of our alert members yesterday. You can see the 19th of April. And this trade, basically, to kind of summarize it quickly so you don't have to read everything, but we were looking for just a kind of a moderate move up or down, and so it didn't matter directionally. So you can see this trade says earnings trade set up today for earnings before the open, which was today. So JNJ announced today before the market opened, and so this was doing a double calendar. So basically we bought a 165 30 April 165 call, sold the 23 April 165 call for a total cost of $42 was about the debit cost we're looking at. And then we did a put calendar. We bought to open the 30 April 160 put and sold the 23 April 160 at 41. So total maximum risk of this trade, if you set it up, was going to be a total of $83 per spread. Now I want to walk you through the trade. This thing ended up making over 1,000%, or basically on no risk after we adjusted it. So let's take a look at the trade. So here's the chart of J&J. So it went out yesterday on the 20th right here, closed at about 162.50 right here. So we set this up before the close yesterday. And then the earnings were this morning, the 20th of April, before the open. So it opened up, and it kind of opened up down a little bit. So if you look at the 15-minute time frame, you can see when it first opened, it kind of popped up here and was trading about 164.75. And it traded here for about 15, 30, about 45 minutes. So we were in the trading room looking at this thing, and then it started to push towards this 165. So we were looking at the game plan was to leg out of the trade, so we legged out. And here's how that trade transpired and the outcome of the trade. So walk you through the steps. So the trade origination was doing the 30 April 165 call long, short the 23 April 165. So that's one part of the calendar. Then the other part was the put calendar. So the 30 April 160 put long, short the 23 April 160 put. So total risk 39 plus 40. So total risk on the trade setup was $79. Now, without doing anything, this trade went out today up about $2.44. But what we did was we closed out the call side in the long put, and then stayed long the call for next week. So let's walk through the trade. So closed out for this trade, the view was it was going to go up. So what we wanted to do was close out the long put. So closed out the 30 April 160 put, took a loss on that, and then left short the 23 April 160 put that was short against it. So this is a calendar. We're long the 30 April, short the 23 on the 160 put. Now then the other part of the trade was to close out the short strike of the 23 April 165 call, took a loss on that, and left open the short put here, the 160 short put. So in summary, closed out the long 30 April 160 put, took a loss, closed out the 23 April short 165 call, took a loss, left open the 160 short put for max profit, and now ended up long with the 165 call with an adjusted price of, I'll show you where that is. So the original price of the 165 call, long call, 30 April was $1.13 or $113. Now took a $40 loss by legging out or closing out the short call, the 165 short call, and the long put at 160. So that adjusted up our price on the long 30 April 165 call to $1.53 or $153. Now the problem with this is you don't want to stay just long this 165 call, because see the negative theta, $8.38. So you start losing if it doesn't move higher. So what we did to offset that was sold the 167.5 call for next week, the 30 April, against it. So when it was pushed up to kind of the highs of the day, sold that 167.5, brought in $165 or $1.65. Now look at the difference here. So the cost, we adjusted our cost down of the 165 long call to $1.53, but we were able to sell the 167.5, $2.50 above it when the market was up here towards these highs at $1.65. So now we have zero risk. We actually have a $12 credit. If it goes out next week at over 167.5, the max profit's $262 per spread on zero risk, actually a credit of $12. But we took it even one step further to make it even better and sold the 30 April 170, 172.5 bear call credit spread, brought in $44 there, made the adjusted trade into what we call long call condor. Now now the trade has a total of $56 credit. So if it was just a collapse to the downside, we'd still make 56, or if it exploded to the upside, we make 56. If it goes out between the two spreads, we'll make $306 on zero risk. And it went out today, you can see up $149, almost $150 on zero risk. So if you'd like to learn more about these types of option trades, when to place them, when to use them, make sure to join me at powercycletrading.com. Good luck trading.